Did you just book profits on Tata Technologies or IREDA after the stupendous listing gains? Well, you need to be ready to pay the short-term capital gains tax. Hello and welcome. You're watching Business Today Television. I'm Sakshi Patra, and in this video, I will tell you all about what are the tax implications that you need to be aware of if you invest in IPOs and then book profits on the listing day or even after a few days after the listing of these stocks. Massive listing gains have been recently witnessed on IPOs by Tata Technologies that got listed at 140% premium, went on to giving 180% listing gains on day one itself. IREDA that gave you 85 to 90% listing gains. Gandhar Oil, flare writing IPOs also gave upwards of 50-60% odd kind of listing gains as well. In case you were allotted these IPOs and then you went on to book off these massive listing gains, then you need to listen to this video very carefully. Calendar year 2023 has seen at least 15 stocks being listed with an exuberant 80 to 100% surge on the listing day. After a company sells its shares to the public for the first time in the IPO, they get listed on the stock exchanges. But in case you were one of those investors who invested in this IPO and then later on exited after booking your profits and you made a profit on the understand the tax implications on these gains that you were making on the day of holding the stock. IPO stocks are actually taxed just like any other stocks on the listed stock exchanges. Rules say that if you sell shares within 1 year of being allotted the IPO, the profits from the share sale of this IPO stock will be taxed as a short-term capital gains tax. So you will have to pay a tax of 15% plus the higher education cess as well when it comes to booking your profits, and on profits you will be taxed as much. The tax will be lower, however, of about 10% if you hold these IPO allotted shares for 1 year or even beyond. Hence, for instance, Tata Technologies shares, if you had got allotment during the IPO, they will turn long term only by November of 29th of 2024, which means in case you want to reduce your tax outgo from 15% short term capital gains tax to 10% long term capital gains tax, you need to hold these shares till November 29th of 2024. Now, many senior citizens and even low-income earners also may have applied for this IPO. And under their rules, the basic tax exemption limit is 2.5 lakh rupees for ordinary citizens, 3 lakh rupees for senior citizens within the age bracket 60 to 80 years, and 5 lakh rupees for super senior citizens of 80 years and above. In simple words, if your income is below the threshold limit of 2.5 lakh rupees or you are within this certain age group, you do not have to pay income tax, or you will have to pay it as per the income tax bracket. If you are a senior citizen or a super senior citizen, if your listing day gains are below the threshold, that is below 2.5 lakh rupees of the income that it will be treated as, you do not have to pay an income tax on the sale of your shares. But can you really reduce your tax outgo as a general citizen in case you fall under the tax ambit or you have an income tax to pay on the salaried income that you earn? Well, the good news is that there are ways. You can deduct some charges and other specific losses to reduce the overall tax on the profit amount that you gain from these IPOs that have recently listed. For individual investors, the application money is not taxable as income. The brokerage paid can be deducted from the profit for taxation purposes. Alternatively, if you also made a loss while selling any other asset, you can adjust the same from the IPO profit. If you have incurred any other loss during the year by selling shares or other capital asset, then you can adjust the same loss against the profit that you earn, say on Tata Technologies or IREDA or any of these IPOs that got listed that doubled on the day of the listing, and therefore you hold a maximum amount of profit right there just by holding it for one single day. You can adjust it with the losses that you may have made to the similar tune. You can adjust any short-term capital loss made earlier between April to November 2023 against the short-term capital gain made, say, in Tata Tech or IREDA or Gandhar in November 2023 or by December if you're selling it this year, or maybe till the time this financial year expires. However, if you have incurred a long-term capital loss, then it can only be adjusted under a long-term profit as well. So ensure that whenever you are adjusting the losses, they are short-term loss to short-term profit, long-term loss to long-term profit. But why is this really advised, and why do investors and analysts tell viewers to hold stocks for more than 1 year? Why is it generally advised? Well, apart from the lower tax rate, from 15 to 10% already your tax outgo becomes less for the long term, there are also many benefits to holding assets for 1 year or more. An important one is that profits of up to 1 lakh rupees are shielded from tax if you hold them for 1 year. That's long term. This benefit is actually not available if you sell within 1 year, which comes under short term, and hence the short term capital gains would be charged on every penny earned if you sell on the listing day. So when the Tata Technologies stocks double, you do have to pay tax on the profit earned. Purchasing IPO shares using borrowed capital is also done very frequently by a lot of people. Now, the income tax lens here changes if you frequently invest in IPOs using loans. If it is established that you actually borrow money, then invest in IPOs, then the income tax department can claim that it is actually business income that you have made by investing in IPOs, because if it is a frequent practice, then the income tax department will take notice. So if you have earned business income, you must remember that the tax applicable on the share sale will be as per your tax slab and not as short-term rate of 15%. So business income is taxed absolutely differently. Many traders also do not declare that they are professional traders or traders by profession. So that is something that you need to really pay attention to. Pay your taxes on time and under the right tax ambit, and that is absolutely key. You can only claim all the benefits of deducting expenses from the IPO gains if you file your tax returns on time. That's usually by July 31st every year. You also cannot use the simple tax return forms of, say, ITR 1 and ITR 4 if you have a capital gain to declare and to adjust as well. So in this case, what you need to do is go back to your financial advisor, go back to your chartered accountants to really help you understand which is the ITR form that you really need to file every year in case you earn your income by investing in stocks, by investing in IPOs, whether you do it professionally as a trader, whether you do it on an everyday basis, you earn your business income from borrowed money and then investing in IPOs and then repaying the loans by the profits that you earn from IPOs. All of this needs to be really thought through carefully. And of course, when it comes to the taxation ambit, any share sold within 1 year of holding will attract short-term capital gains tax of 15%. Any shares that are sold beyond 1 year will attract a long-term capital gains tax of 10%. And the adjustment can be done. You can deduct some charges. You can deduct some of the brokerage charges and definitely adjust these gains to the losses that you have made, and all of that can be done with the help of a professional chartered accountant for you. So ensure that in case you are in this practice, do seek professional help over here. With that, we will wrap up this special edition, but do stay tuned on to Business Today TV to get more information about the world of business and stock markets.